Hey everybody, wanted to do another update video. Last week we talked about volatility in the markets up through March, and now with that volatility's hit again here in April, a little worse this time. In that video we talked about how on April 2nd Trump was going to make some announcements for tariffs. There was a lot of projections about what they would be, but I think it shocked even some of the most pessimistic views on where he could go with them or what could happen. That's caused today, Friday on the 4th, to be the worst day since March of 2020, and yesterday was the second worst day since March of 2020. I remember that day actually really good back in 2020 because it's when Macy was born. Had a 5-year-old at the time, or now at the time when she was being born. We were headed to the hospital on March 16th, and that's the day the Dow dropped about 3,000 points, and I remember how it felt, to be doing that and having the market in turmoil and knowing that I needed to be talking to people and doing all the things that advisors are supposed to be doing during these bad markets. Had Macy on Tuesday the next morning. Worked part of that day. It felt like things were crazy and the world was almost ending because there was this really big unknown of what was coming after that. Well, fast forward a couple months later, the market rebounded. They realized the world wasn't going to end. And by July the market was back up. That don't mean it was comfortable at the time, but that was still kind of the feeling at the time. This downturn feels a lot like that in some ways. In that it's a speculation driven downturn, right? Meaning that where everyone's selling now based on what could happen. The assumption that Trump isn't going to back off of his tariffs. The assumption is that the reciprocal tariffs that the other countries are starting to place back on us aren't going to be done away with. So everyone's kind of planning for the worst. We don't think that's going to be what's going to happen. Somebody's going to blink, right? Trump's going to have some different version of the plan. He wants the market to be strong. He's campaigned on that. He wants to be the stock market guy. So a couple of things to note about what we're seeing. One, he's put a 10% tariff on pretty much all goods. There's a few exemptions, but for the most part, 10% tariff on those. Those kick in tomorrow. There's a reciprocal tariff, meaning that whatever the country's tariff is on us, we're going to put back on them for goods coming into this country. That kicks off on the 9th. And really the unknown of how that's going to affect things is what's caused a lot of the volatility that we've seen. Some of the questions we're getting are things like, hey, is this going to restart a recession? And it could, right? If things don't change or there's no pivots to the plan, it could. But again, it's largely a speculation-driven downturn, meaning that they're trying to guess what's going to happen. Is this going to happen or is that going to happen? And we just don't know that to be sure. Just like with COVID, we didn't know what was going to happen, so everyone kind of panic sold. But the interesting thing with COVID, as we look back, when the market did hit that bottom and things were at their worst, it started rebounding. Right? I mean, I remember, the 16th, but the 23rd is when the market actually hit the bottom, and it felt like the world was going to end. Well, before there was a vaccine, or before there were solutions, or before we knew what we were going to do, it started to rebound because everyone said, "Hey, things are bad now. Things are going to get better again. Let's go ahead and get back in before things get better," and that drove the market back up. And by July, it was back to where it was before. And some of those who sold during that downtime sold and wasn't able to recover that money. So, selling ended up being a mistake. But at the time, right, it was kind of hard to know what was going on. Another quote I remember, somebody said, and they said this being serious. They said, they were kind of panicked. It was somebody that worked for me, and she looked at me and she said, "Matt, this time it's different." And it's kind of funny because Sir John Templeton of Franklin Templeton Funds, wasn't of them at the time, but started Templeton. He used to say the 4 most expensive words in the English language are "this time is different." So, when he hit on that just for a minute, we don't think it's time to sell. Of course, we can't blanket that approach. Long-time investors, right, need to continue to look at the long term. If you look at portfolio performance, even after today, going back 2 years, it's still healthy, it's still strong, even though 2025 doesn't feel great. So there's a couple of things I would suggest you do, right now. One is review your plan. Make sure that everything that your risk levels are appropriate. Make sure that your plan is still in place, and just remember, your assets are managed to a particular plan, right? Not just to the highest return possible. We want the highest return possible, but to get the highest return possible, we have to take on more risk. And, times like now, you realize why you don't want to take on that extra risk. The fixed income stuff, bonds, right? When they go down in value, or I'm sorry, rates go down. People flock to safer things. When they drive money into those bonds, it drives those interest rates down, and then those bond values go up. You can think about that, you just kind of conceptually. If you have a $10,000 bond and it's paying 5%, and rates go down, and now you have a $10,000 bond, yours is still paying 5%, but somebody can only buy one that's paying 4%. That means they'll pay you a premium for the one that you have to sell it. You have something better than what someone can go get on the open market. And we've seen that happen now. We've seen as the stocks have gone down, interest rates have gone down with it, and the bond values have gone up. So that's been one thing that's worked really well. So, but anyway, one step is review your plan. Two is, and we'll do this for you if your clients of ours, is rebalance regularly. We were rebalancing clients late last year. We were, moving money out of the market into safer things because we knew some volatility was coming. We didn't know when, right? But, we haven't seen normal volatility since late 2022, early 2023. Things have been pretty good for a while. So now this extra, this bad time feels even worse because it's coming at the end of a really good time. When, in all actuality, a 10% drop every couple of years is normal. Maybe the reason is different, but it's still pretty normal. So, one, review your plan. Two, make sure that you're rebalancing regularly, right? If things are down, we need to pivot some more into stocks. It's not the time to sell. Three, there's some other opportunities that can be taken right now. One would be converting money from an IRA to a Roth, right? Tax brackets are still fairly low. If you're in that 12% bracket, it's possible to pull some money out of your IRA, move it over into your Roth, pay 12% in taxes on it, and again, assuming lower bracket. And if you do that with money that's down, when that money rebounds, it could rebound tax-free. So there's some tax savings there. The last thing I would tell you during this downturn is have a long-term perspective on it, right? We don't normally recommend, I can't think of any instances where we recommend people buying stocks with a goal of less than 5 years. The market tends to be pretty safe over a long period. Short term, not so much. We know the market helps us hedge inflation. One of Warren Buffett's quotes is, and he'll say one of the best ways to hedge inflation are to own the companies that create it. So if you think toothpaste and toilet paper will cost more in 10 years, well, we can buy Procter & Gamble stock. As that stuff goes up in 10 years, the stock should be worth more money. So it is a good inflationary hedge. It's also not very linear. So those are some things, just to kind of recap what I would suggest. One, review your plan. Remember, your plan is your plan. We plan for this. If we built your plan, we know this is going to happen. Lots of our returns over the last couple of years are double digits. If we're saying, hey, long term, we think you're going to get 7%, for example, and you're at 11, right? I mean, again, we've planned for 7. We haven't planned for things not to ever go down. 2, rebalance. So now's a good opportunity to be transitioning some of that money. So if you're supposed to be half in the stock market and half in fixed, and you're 45% in the stock market, now's a good chance to move a little bit of that fixed money over into your stock side and have the upswing there. Talk to your advisor, talk to us about doing some sort of IRA to Roth conversion. Because if you're down a little bit and you move that money over into a Roth and it rebounds, that money could rebound tax-free. And 4 is make sure to have a long-term perspective. And with that, I would almost say turn off the news. Don't watch too much of it. It's designed to get you emotional. It's designed to get you watching every day, right? Back during COVID, one of the things I remember when that happened on March 16th was the headline was the worst day in the history of the stock market. That wasn't true at all. The stock market dropped like 79% during the Great Depression. You had Black Monday, which was 23.7% in 1987, right? But based on the number of points that it dropped, the Dow was down 3,000 points. They made that claim, even though there were lots of days that were worse percentage-wise, not point-wise. But your portfolio value moves in percentages, not points. When the Dow was 10,000 points, a 1% swing was 100. The Dow at 40,000 points, a 1% swing is 400. So the numbers have gotten bigger, but that doesn't mean that the bigger the number, the worse the performance, right? We want to look at the percentages. And again, like I said, reach out to us. That's what we're here for. We've got 5 of us that are on staff. We're making calls. We're doing what we can too. But this video is another great way to kind of update you on the markets, what's going on with the tariffs. We don't. It could be short term. It could be a little longer. But either way, until we have more concrete financial data to say this is what's going to happen, it's hard to justify, doing anything rash because, we don't know. It's speculative, just like it was with COVID, and we expect it to rebound just like it did with COVID. So stay the course and reach out to us if you need us. Have a great day.